Welcome everyone to our one-year review with Enders Capital. I'm Mike Wadkins. I'm the Chief Brokerage Officer at Composer. And for those of you who may not be familiar with Composer, Composer allows you to build trading algorithms with AI, backtest them, execute it. That's all on one platform with no coding skills required. So just a quick disclaimer, this is not investment advice. Keep in mind, investing involves risks. Examples are for illustrative purposes only and are not a recommendation, an offer to sell, or solicitation of an offer to buy any security. And past performance is not a guarantee of future results. Great. So I'm joined by Moody Nashawaty, CEO and founder of Enders Capital, and Risley Mabile, COO and co-founder of Enders Capital, Moody and Riz. Thanks for chatting with us today.
Good to see you. Glad to be back.
Great to be here.
So 1 year later, I'd love to just kind of start with both of you giving a brief intro, and then we'll go ahead and dive in.
Great. Yeah. So I run Enders Capital. We are a small boutique hedge fund. I got into Composer a few years ago. I really loved what I found there. I've been trading the markets for a long time, and I needed a place that was systematic. And, I really liked the algorithms in Composer and building in Composer. So fast forward, I put my money to work. I liked what I saw. There was some interest from friends and family. We ended up building a fund. And we're now a year in, and things are great. And Risley here is one of our partners. I'll let you introduce yourself, Risley.
Howdy, I'm Riz. I am also a longtime derivatives trader of, like 8 years now. Me and Moody traded together for a long time prior to doing any of this stuff, and we started messing around with these algorithms. It's been a few years at least now, and thought it was really interesting. I think Composer has an interesting edge with how quickly you're able to test ideas and change logic trees. We went down that rabbit hole and it was going really well, and ultimately, we got super excited about what we were doing and one day just decided to put that money to work. We had other people, like Moody said, that were interested. Outside of what I'm doing with Moody, I am also a physician. I'm currently in diagnostic radiology residency, so I'm busy, but yeah, Enders is where my heart is most of the time.
Fantastic. Thanks for that intro. Yeah, you guys have been a long time users, so it's great to see the transition. So we're going to cover a lot of ground here. We got some community questions over the past couple weeks. We'll go ahead and have a Q&A at the end, but I want to kind of jump in here and let's just kind of do a brief overview of Enders history. You guys started just over a year ago, and then we'll dive into kind of like a full performance review 1 year later from our previous webinar. And for those watching that have not seen the previous webinar, please go to YouTube, Composer Trade. You'll be able to see kind of how Enders operates. They gave you a little bit in depth into the previous strategies that they may have used. So it's definitely worth a watch. So I'll let you guys go ahead and kind of dive in.
Yeah, I think the light bulb went off when we started putting strategies together and just discovering, look, I think like when you look at why we choose Composer, the long view of investing is so that, markets just tend to go up for a long time, assuming, that we're always printing currency. It's just always going to happen. And I think that we try to build out different strategies that could capture, markets in different regimes. And that's like the big giant view of it. And then when we realize we can build models that trade markets in different markets, we can put them together and try to, at the end of the day, smooth out your return curve as much as possible. Personally, I ran a big company before this and I needed a place to put my money, and I have a ton of real estate. I've got some venture capital, and I really just wanted some place where I could get uncorrelated returns against everything else that I had if like a 2008 scenario would happen. And I needed it to be systematic so it could all happen without me having to do it myself. And so in the times of, I think like one of the biggest focus points of our fund is trying to take the least amount of risk as possible in a very systematic way. And so I've studied basically every single bear market we've had. I've studied we have like a lot of algorithms that are literally just designed to capture volatility, but also just either go short the market or, just really call out crises as they're happening. And one, create an airbag for the portfolio, but really just switch to risk off as fast as possible as well. And then in just looking at that over the long sort of strategy and us operating the fund, I'd say we've determined and figured out like the magic of uncorrelation, which is like a lot of old principles is actually reign true, right? which is what we've seen. And, you see Ray Dalio and his sort of free lunch theory, and just bringing down the more uncorrelation you have in a portfolio, the smoother your return curve is. And I think like with algorithms, you can get uncorrelation in 4 different ways. That's like asset to asset is the obvious one, but also how they trade, what signals they trade off of, even if they're trading the same asset, long, short, and then how you allocate to all these algos. You get just so much uncorrelation that you just wouldn't get from just buying and holding assets. And ultimately, at the end of the day, for me and my money, this helps me sleep at night, and is really why we're here. Long-winded answer there, and hopefully we finally, I think, got there.
Yeah, and quick piggyback. So ultimately, like the way this conversation sort of unfolded, and this is not unique to us, it's the entire hedge fund industry, is like we're not interested in seeing half of our money gone at any point. We don't want to see 40-50% drawdowns like 2008, no matter what happens. So some sort of, I think there's a huge role for some sort of systematic active management, and people try to do that, 18 ways to Sunday, but we have our own way to do that. And, I would say rather successful traders of our own capital, this just seemed like kind of a natural progression. Like we know you don't have to tolerate those drawdowns necessarily.
Yeah, definitely. And your last webinar that we did, you guys kind of went in through how your symphonies are correlated or not correlated to each other and how important that is. I'd love for you guys to just dive in a little bit more on, 1 year performance review of how your funds operated, specifically going in, you talked about how your strategies aren't correlated to each other. How has that panned out over the course of the year? I'd love to dive into that a little bit further.
Let me go ahead and show you our dashboard that I just built on Claude last week, which connects to the API. So there's probably bugs in here, and that's fine. Portfolio value here, you'll see like we're trading a little bit over 5 million. We're up nice $40,000 today, just about. Year to date, we're up about 5.4%. Our performance since we started, which was back here in March, is up roughly 35%. This is not our NAV. This is not our, we charge 2 and 20. And I just want to make sure people understand that, like, I think after NAV, this is actually closer to about 30% back to our investors. The S&P in the same time frame is up about 19%. And I think we look at this, I built this dashboard with the API. Anyone on Composer can do this as well. But, I think so far we've been doing really great. We got a max drawdown of 7%. You'll see the underwater plot here. Our whole goal, and my goal personally for my own money, is I don't really want to lose more than 10% ever. Does that mean we'll have drawdowns more than 10%? Probably. But I'm really trying to maximize the uncorrelation and risk factors to make these drawdowns quick, and then also not more than 10%, 99% of the time. Will we have bigger drawdowns? Probably, likely, but not in a way that I think we're trying to have high volatility in the fund. Our volatility currently sitting at 16% across the portfolio. And I've been able to map out a couple of different things. Our beta I think it varies quite a bit. It's very rare our beta is above 1.5 into the 2 range. Here it was here, and then here. Lately our beta has been under 1, if not negative. And again, that's by design. Here's a sector breakout of everything we're running today specifically, right? So we have a pretty large cash position. Our beta in the fund is sitting at 0.8. We've got tech, commodities, emerging markets, broad market, quite a bit of different things. And again, this is like our design for trying to bring as much uncorrelation as possible to reduce drawdowns, but also keep our equity curve up and to the right. So, and I think we've done a pretty good job. I can actually walk through like some of the thoughts that we've been having and a little bit of like, how things went, coming out of the gate when we launched our fund back in March. It was probably one of the most fun times to be launching a fund. And, we had a little bit of volatility. We tried to buy the dip a little early. We recovered that pretty quickly. And then, the rest is kind of history. There's some time here where the algos kind of, walking out of the gates wanted less volatility. And I think like when we went the batch of algos that we had out the gate, I'd say They were probably slow to catch this transition to the upside, but eventually they figured it out. We run up. Here's a big learning that we had where we figured out, how our algorithms could, transition into being a lot more correlated. We since then, changed the structure of how we run our algorithms and eliminated some of that uncorrelation, because when this happened, that's essentially what was happening there. And then as we've gone on, we've added more models, we brought AI into the mix, we optimize our algorithms, we use a little bit of machine learning, and we've just essentially made, I think, a better batch than ever. And I think so far, I think a 34% return on my own money, and I think our investors are also pretty happy as well. And so things have been great. I'm going to pause there. Unless maybe you want to see more of the dashboard, but we got a couple of different.
Yeah, as much as you want to share here, and now we've seen a lot of questions pop up with this. Now, are you guys leveraging individual assets? Or are you leaning on ETFs or even leverage ETFs? We see that throughout the platform.
Yeah, I'd say
of everything.
So look, there's a reason to use leverage ETFs, and you have to consider what we're doing there. Within our portfolio, we're not ever using one leverage ETF. It's not we have 77 positions on, I think, right now. The idea is to keep our beta. One is we want uncorrelation to the SPY, which I think we have, and then we are also just trying to keep our beta in places where we're only really having a higher beta than SPY when it's advantageous for us and makes sense to do so. So yes, we do use leverage ETFs. We don't use margin. We don't use everything here is stocks and ETFs for us. We're not trading options or anything like that. And so if the question is really around leverage, well, if we're using leverage ETFs, but we're, a lot of our positions are in other things, really I kind of look at them as almost like they're high beta stocks, similar to trading like Nvidia or Meta, but in this case, they're ETFs, right? Here's all the different models we're running. We have 18. We try to keep them for the most part. This is an indicator model for us. It's not one we're actually allocating to. We try to keep them pretty close in terms of value, and so usually they're within 1% to 2%, 1% to 3% of each other. And so a lot of the models have very similar volatility, so they don't really change too much there. A lot of our models haven't been live that long. They're either newer models, and we've swapped out quite a bit. I mean, even the models we started with aren't even here. I mean, these are the oldest model we have is from 3/28 of last year. We started 3/6. Some of our models look like gold because they do trade gold, but essentially it's been pretty decent. So I've got this here, there. This I look at a lot. I'm trying to keep my algorithms pretty uncorrelated, and so we have a correlation matrix here. I look at live data, how are they uncorrelated currently, how are they uncorrelated on a longer back test standpoint. I think this is them uncorrelated since 24. I can look at older models, some of them might be missing data, that kind of thing. Current correlation to each other is sitting at 34%. Our correlation to SPY is at 29. This is some other interesting charts here. I actually like this a lot as well. This is our correlation during drawdown matrix, and so when the SPY is losing money, we're only 18% correlated to the SPY, which is really great. 19% correlated, and then these are 18% correlated to each other when they're losing money. Some of these are really designed to be negative beta, and are designed to really become an airbag to the portfolio when things do turn. Otherwise, some of our gold algorithms, we have some algorithms that trade other commodities as well, are just super uncorrelated to the rest of the market. And really, we're just trying to, from a risk standpoint, we don't really want to be more than 50% correlated. Sometimes there are some larger correlations between algorithms. A lot of the times because they act in similar nature. They trade broad markets or trade a group of different algorithms that we have as well.
So you mentioned one thing there specifically when you're looking at your overall symphonies and kind of your graph as you're doing it. First off, this is all through Cloud Code Composer API, correct? I think you mentioned that at the start here. Yeah. Specifically, as you're tracking gold, recently metals like gold and silver, they skyrocketed. And, there's multiple theories around this, whether it's like the devaluation of the dollar or retail all going all in while smart money is going out. And you saw that dip. Surprised by this? How are you handling those different algos that are seeing the growth in metals? Are you looking at each individual asset and kind of charting those trends? Or are you more of just like, there's the classic hedge fund where they're just like sucking up all information possible. So how are you kind of parsing that information and kind of modifying those algos and knowing when to jump in?
So that's a good question. Risley, you want to talk for a bit? I mean, I'm partial.
Yeah. I think there's kind of multiple things there, right? I mean, some of this is just seeing a little bit of like general market read. So like, for example, it doesn't take, insider data at a hedge fund to know that we are rotating sectors right now. It didn't take one to see that gold was trending. So, there are different things that grab our attention sometimes and will point us at a sector, and then we'll pay closer attention to them and model them. So that process takes a while because every ticker sort of has its own personality. Every sector has its own personality. Consumer staples doesn't move anything like tech moves. So it takes a little bit of something grabbing your attention and then going and spending some time with that, building a model on that, and then, going through all of the different kinds of stress testing and walk forwards and all the things that we do, and then ultimately kind of bringing them forward to live and seeing what's happening with them. There are what I don't want to give the impression of is that we're directionally correct. So for example, me and Moody are split right now on emerging markets. Moody is pretty bullish emerging markets. I'm not particularly bullish emerging markets. But we don't have to agree because that model crushes both directions. So that's one of the lovely things about being in a quantitative fund and having systematic deployment is like we can have our macro arguments, but it doesn't matter. The model's going to run, and we do agree that the model works. So that's one of the kind of fun things about running a quant fund. We send out these email updates, and every once in a while we get replies asking, "Hey, what do you think about XYZ?" I'm like, I don't know, but I know that I trust my model to run it well.
Risley's discussions on whether or not we like an asset is usually a question of time frame and not whether or not we actually like it. But look, I think we try to build models thinking about what's going to happen in the future, but we don't activate them trying to capture alpha. We just let them activate on their own. Especially like the worst thing you could do is try to chase gold now, or like we have gold miners we're not trading gold miners now, but we were trading gold miners for the last few months. And they were fantastic. And honestly, I don't know if gold is topped, and it's very volatile now. And if you look at a chart, it looks like, a knife has gone through it. And I can't tell you if it's topped or not, but I can tell you that our models will adjust accordingly, and they'll trade if there is an opportunity there or not.
Yeah. I was just going to comment because of what you said earlier. So in terms of like editing and making changes to strategies that we're currently running on different sectors, I would say that only happens insofar as to make sure that the volatility of that strategy meshes with the rest of the portfolio, right? So if you're trading gold 6 months ago and you're using a little bit of leveraged ETFs to do that, that's one thing. But if you're using a leveraged ETF right now, it's going to be a very different experience. So that will change the way that we run strategies on things.
Yeah, and when Moody was showing that dashboard, particularly, you saw some of those strategies, even at its earliest, were kind of March of this year. And there was like modifications to them. So are you kind of constantly adding new strategies as a whole, or are you just rebuilding off existing ones because they're tried and true, finding new data, new kind of points to modify, or are you starting from scratch as you kind of go over time?
Yeah, so like we built and I've got an engineer on my team who is currently anonymous because he works for big tech, and he moonlights with me, and he gets paid way too much for me to even match his salary at this size of fund. But eventually we are going to work something out, and we're all very excited about that. He's been able to build quite a few things for us in the last 6 months. One of the things we built was just a backtest extender. When we trade with Composer and you look at the backtester in Composer, you get ETFs. I can't backtest the 1970s with gold just on GLD, right? So we go and pull the spot price and be like, okay, like how does this algorithm work since 1970. And it doesn't have to work all the time. That's the reason we care about uncorrelation so much, is like, if there's algos or markets that are just not doing well right now to trade, then we have other ones that will carry the rest of the load. I'd say even the last 2 to 3 months, our money hasn't necessarily been made trading general market things. We've been making money trading commodities or the rotation that's happening, or gold's been a good one. Emerging markets has been a good one. So like, I think that's why we care so much about uncorrelation. So again, like, we care, like, our philosophy on back testing is so about just getting the really, really longest back test you can possibly get. And then, because Risley and I have such like deep trading backgrounds, we can tell really quickly whether or not something is overfit or not, and then where potentially there's pitfalls. I think a lot of like these algorithms that we have that exist in the Composer database, like, they'll have front runners that'll put people into volatility really quickly, and that might not be like what people want for their own money all the time. And so, like, I think like sometimes you have to go through and look at like the logic that you're running and saying, well, if the market is overbought or oversold, am I okay taking a position in something with really, really high volatility when the rest of my the rest of the days I'm trading at like a volatility of 15 or 20, and then one day I'm trading at a volatility of 40 or 60? Like, does that match the behavior of what we as actual fund managers have promised to our investors? And what we're in terms of what do we, and I think like, I call Risley, I'm like, hey, I think like if these scenarios happen, the volatility might move in this way. Or recently gold's been highly volatile, like a lot more volatile than we originally wanted as an algorithm. And it's like, should we dial back the volatility now that things are a little bit more elevated? How do we think about that? And like, that's probably the only change we've actually made on the algorithm since we've been running, besides just optimizing for alpha and optimizing for uncorrelation in new markets and new algorithms. Like, this is the first time where we were like, we're going to scale back the volatility just a tad on gold, because we think it's been so concentrated by everybody that it's just more than we wanted as an algorithm in our portfolio.
Yeah, and speaking to that, how often are you guys manually intervening and rebalancing if there is some sort of event that happens, some new tweet? The past couple of days we saw, several down days in a row. Some people's strategies had significant drawdown over things because they were in one of those front runners, those leverage ETFs. How often have you guys intervened into those strategies to either liquidate all or just like rebalance now because you like what you're seeing?
Yeah, so we have a systematic way that we intervene when things are going against us, if we're on the wrong side of the trade. There's kind of two questions here. So as far as intervening with the positions we have and like liquidating, we have a systematic way that we deal with that. Ultimately, if it was only my money that I was running, I would never touch them. I would just let the models do their thing. But we have a responsibility to our investors, and so we have a cutoff for what we're willing for the models to take. We've never had to do that. We've never been forced to do that according to that systematic approach. And the reason why, and one of the videos that I made that's on my LinkedIn that I just posted about 2 weeks ago, I actually am about to post it. Sorry. Is exactly about why we don't.
Little sneak peek.
I know, yeah, sneak peek. It's about why we don't override the computer. And the long and short of it is like, we don't have data for those discretionary interventions, and we're not a discretionary fund. We're a quantitative systematic hedge fund. That's what we do. So we only intervene in a systematic way because we can't model that. We can't model my read of intraday price action versus Moody's read of intraday price action and then know who to listen to if one of us wants to and the other one doesn't. You can't model it. So we don't do that. We have a systematic approach to do that if necessary, but it's not been necessary up to this point. As far as rebalancing goes, ultimately it really depends on the volatility that we're experiencing in the sectors we're in. I have an acceptable divergence between the values of each of the strategies that we're running that I will sit on, but once it crosses a threshold, I may be rebalancing as often as every day if stuff is really moving. Like in April, Whereas there are other times where, the market's asleep for 2 weeks and nothing's moving, in which case you don't necessarily have to rebalance that often.
I mean, the only time, exactly. So, like, we really rarely would ever intervene unless there's something just completely. I mean, we talk about nukes is like the only way that we're intervening.
Yeah.
It's something just insane that it's like, okay, well, this has never happened in history ever, so now we're intervening. But it's not going to happen probably in our life.
Yeah, so
unless
the Dunes comment here. So it's one thing when you're running your own money. It's another thing when you're running other people's money. And if you're sitting looking at a position that is offsides and getting worse, then the drive to want to intervene can be very strong. We don't, again, I'm making a whole entire video about this at the moment. I encourage you to follow me on LinkedIn and see that when I post it. But yeah, to Dune's point, like, you're correct.
Yeah, that's really important.
So yeah, I mean, if we have such a quick reaction time built in the algorithms to go risk off in the crash scenarios, and that's like by design. So it just wouldn't make sense to intervene. And then how many times have the market's down like 2% and then immediately V shapes, and you're just like, oh well, we were down 2% and now we're green, or something like that happens, and that's fine. It's just normal volatility of day to day.
The best thing to do on those days is to zoom out and just remember what it is that we're trying to do. And it is not to catch intraday price action. That is not what we do. We run models for the long term, and just because 1.5% down happens to be a 2 standard deviation move for us. Like, 2 standard deviation moves still happen. Just relax. It's in the model.
Not my favorite day, but it happens.
We've seen a lot of them recently, right? Like last week, we saw a sudden correction. The start of this week, it was down. Today, it's going back up again. Just across the market, just seeing red and then seeing green. How important has AI become in your guys' kind of workflow as you're looking at your existing strategies, you're performing back testing, you're trying to look at news, make changes? How would you characterize AI in your current workflow? And how has that changed from when you started? Start using it.
Sure. I mean, it helps with research quite a bit. I've already started building tools on Claude. The dashboard's one. I'll show you another tool in a second, but the main thing is you can use AI to optimize your algorithms and run historical modifications to your algorithms through certain time periods. So that's something we've done as well. So some of our algorithms, we'll take one algorithm and then we'll optimize it for different regimes. Let's say we have a 20 or 30 year algorithm of back tested data. I'd be like, all right, well, this algorithm performed XYZ over this amount of time, but how did it, what was the best algorithm for 5 year increments? So it's maybe 2000 to 2005, or 2000 to 2010. And it's which were the best models or parameters for each of those time periods. And then, just a standard walk forward test where it's okay, you set them live in 2005 based off the last five years. How did it go moving forward? And what we'll do is we'll optimize an algorithm for different periods, and we'll mash them all together, and then we'll run that, and we'll see now, we don't have to necessarily have the best optimized algorithm. We have ones that are great for different periods. And if they end up working well anyway, then now you're just kind of playing with the margins there. But you can start to run a lot of different models that are very similar to each other. And the market will decide which one is the more profitable one. And then you can kind of dynamically allocate to the one that's doing better on a rolling change of time, right? Last 30 days, last 60 days, whatever. I think I like last 60 days more than any, but those are all interesting ways we've been using AI to look at what we've been building and optimize them and make them better.
And has that been from the start of the fund or periodic?
No, that's my secret quant that's been building a lot of this stuff. And he, we've been doing this for about 6 months now, and our models have only gotten better. And I think the other thing that's interesting about it is we're starting to build a playbook of okay, here's a market, hey AI, here's a playbook of how to build an algorithm on this market. Look at what happened day to day, look at the different drawdown scenarios, look at maybe other signals and how they might interact together, find correlations and uncorrelations, reverse correlations there. And generally you need structure. So like what I've seen a lot of people do, and so I've read like quite a few books on this, but you'll take AI or machine learning and you'll say, make an algorithm, and AI will spit out like a bunch of like correlated scenarios and try to build you like this perfect algorithm based off signals that happened. And it'll have no sense whatsoever, like no actual sense into how it actually trades current like market conditions. It'll just be a bunch of different like coincidences that happen through time. And then you set that live and nothing, like it falls on its face because there's no actual theory design. There's no theory behind like how the algorithm works versus like, and that's like the scary part of like how AI can just be terrible is that it doesn't understand, market psychology, different market dynamics, structure, all of that. And so we absolutely have to start with some sort of theory when we're like trying to build more through AI. And that's currently what we're working on now. I mean, the other things we're trying to do is like build more like support models. Here's another cool tool I just built. This is a strategy builder. I was thinking about just giving this away to the public to play with. But I think like what's interesting is, okay, like how do you find new opportunities in different stocks and things like that? And I built this tool where you can essentially choose like last 20 years, find me stocks. So it's like the first part is just a filter. Find me stocks, the NASDAQ 100. Let's go ahead and rebalance weekly. Over the last 20 years. We've got some slippage here. I just essentially want to like create a portfolio of stocks in the NASDAQ 100 with historical membership, meaning like they were actually in the NASDAQ 100 or entered the NASDAQ 100. And then let's say I add in some sort of like trend momentum filter. There's a bunch here. Let's say I just want to own the top 30% of stocks above their 200-day moving average. And then I want to exit them if they ever fall 20% from their peak. And then they can re-enter if they're still above the 200-day moving average. I just started building this in the last week and a half. I added a bunch of other filters. You could do you can do like fundamental filters here as well. PE ratio, whatever. This needs lacking a little bit of data. I just had to upgrade. And so that's like currently in the process. So we're not going to do that yet. But if you run this, it's going to go and fetch a bunch of different stocks that were at one point in the NASDAQ 100. I've tried to find as much data on dead companies as well, so we don't have survivorship bias. But generally, like this strategy here, if you had bought and hold those stocks, you would have been up 1,100%. This strategy specifically does 8,000% with a 70% win rate on months. Ends up doing a 25% annualized return with a less drawdown over a 20-year span. I literally built this in Claude. Anybody can kind of take this on if they want to. It looks like it does a pretty decent job in 2008, and then it continues on, and it's currently making new highs, it looks like. Obviously, a lot of correlation to the rest of the market, but generally it seems like it does better, and it's up 15% this year. That's pretty cool. But like I think like when we look at strategies like in using AI and like creating new tool sets, like this is something that I would want to build and then build into. So like, here's how I would connect this to Composer. We have really great shell algorithms that are just designed to be risk on, risk off in the market. So like, a couple of simple regimes are probably like a 200-day moving average or some other, there's some other really great ones in terms of like just measuring, credit spreads, things like that. I think like, if you can decide whether or not it's a safe place to be invested in stocks at the current moment, then I can sit there and I can create filters like this and pick a bunch of stocks that are rotated through weekly. And we essentially decide whether or not to be risk on or risk off these specific stocks. And I bet you I can get this equity curve to look a little bit better, especially in scenarios where that happens, or this. We could essentially be more risk off and then risk on when the market's like up and to the right. Of course,
and where does the historical data for this poll? This is a really interesting strategy builder.
This comes from Tingo. So you actually could, if I decide to give this to the public, I was like deciding whether or not I would want to have all the data and give the data, or if people can just literally attach like a Tingo API key and do it themselves. I can't, this is all back tested. all of the standard disclosures, investing in stocks specifically can go to zero, all that stuff. So yeah, but I don't know. This is like something we've been playing around with. It's quite a bit. I've also created like an optimization button. It'll actually optimize these parameters of like what to choose. Now you're definitely getting into over fitness.
Know
when
what you're
do
doing
something
if
like
you click that button.
Yeah, you have to really know what you're doing. Yeah, I don't know. It seems like fun. I feel like this would be pretty useful to the bunch. Would anybody actually want this?
They're pretty focused on.
I'm sure we've seen some great things in the chat
there we
there.
go. Lots of yeses. They were all very focused on your secret,
All right.
secret quant actually just being Claude.
I have to keep that on the wraps.
working
But
out-
yes, definitely. If you guys decide to share this, I'm sure a lot of people will be interested.
If everyone can just go and like follow our YouTube channel, then that's where I would release it. So that's the place to go to. Go find Ender's Capital on YouTube. We have like one video, I
But
think.
there's a whole
But we're gonna start
pipeline. Should be
releasing
about
a lot
once a
more
week moving forward.
We have a lot of education content we're trying to bring out and just get out there as well.
And we'll make sure to link to the relevant channels for you guys, for everyone that's watching this.
And while we're on the topic, since everybody's dropping comments, if you have
So-
things that you want videos about, just like comment or shoot me a message on LinkedIn or something. One of the hardest things about this is trying to figure out what's the biggest value add for the audience. So yeah, feel free to shoot those over.
Fantastic. So we walked through kind of like how you guys have done in the past year as a fund. We walked through how AI plays a role, different ways that you guys look at uncorrelation of your strategies, and then kind of intervention, being systematic. So looking at the existence of your fund, if you could start again knowing what you know now, is there any pitfalls or anything that you would avoid? Any advice you would give yourself again?
Well, I'd probably just be running the models that we're
Yeah.
running right now.
Easy choice.
I mean, it's hard, right? Because like we've both learned a ton in the last year, and all of that learning has been invaluable. Some of it's been a little bit painful, but nothing crazy. Like there's not been any event where I'm like, man, we totally should have done that different, or we shouldn't have used that thing or whatever. Like there's nothing big like that that jumps out to me. I don't know, Moody, what do you think?
Yeah, I mean, the only major thing that I think we would have done better, I mean, I can't look back and say like anything happened. Again, like the only thing I'd be doing differently is running the different things that we've learned over the time. I think like we're really happy. Like our performance is great. My own money is multiplying. Like can't be happier, honestly, with the results, right? You look at 2020 and be like, oh, like, man, if I was just running this one symphony or this one algo, I'd be like up a little bit more or whatever. But it's just not, you can't really look at it and try to build algorithms that way. You just have to, I think the key elements that we've only become more believers of is the uncorrelation factor. Matching volatility is a big one. Like, it just, these are the things that help us sleep at night, and we're really happy with the results. So I think there's only more work to do. I really want to get into trading options systematically. Like right now is a great time to be selling options on both sides. Maybe not on the downside, but we're not. And when I think about that, I think about it like from a risk, like defined risk scenario, like not naked selling in any way. But I have a pretty big options background, and I've explored some of the different platforms out there for doing that. I really want to, if that's something you guys have on the horizon, that'd be really interesting. Mike, what can you tell us about what's coming down the pipe?
That is something that's been requested heavily. We've had our initial rollout of options. I think the biggest thing with automation is the back testing that people want to see historically with options data and trying to build that in. So we've kind of scoped out how that would look. It's just a matter of making sure it's something that people can rely on, and whether it's back testing on the underlying versus individual contracts, because those can change. So there's a lot to it. Hopefully we have more to share in the future with our roadmaps, but that's definitely interesting.
Yeah.
So as we look ahead, because I know we want to make sure we give some time for people to ask some questions, what's your guys' market outlook? You've performed pretty well, I would say, over the past year. How do you guys see the rest of 2026 playing out, and anything that you can share with the audience?
Risley, you're on mute, buddy.
I said, let's see if me and Moody are eye to eye on this. Go ahead, Moody.
Yeah, we can hash out disagreements live.
Risley's like a perma bear, and I'm like more the.
Am I a perma bear, or have I just been for about 3 months?
That's true. He's pretty bearish. I feel like we're in a place where everything just needs to wash out a bit for us to. I think we need another VIX spike is what's my opinion on it. But you look at the 2010 to the 2020, and you just had years where it just chopped sideways. It's like, I don't know. I think the markets move really fast now, and I think that more investors, both on the retail side and investors and on the institution side, are just way more reactive to like get put positions up and going and get short the market and just like go to safety. And I think that creates a lot more volatility in the market on things that like DeepSeek was a great example of. Was that really necessary that day? But I think, my personal bet is that the market will probably chop sideways. I think we'll get a dip, and then that'll just create another bottom that we buy, and then we'll probably see the market higher. I think that emerging markets will probably still keep climbing. I don't think that trades over. I think that gold potentially. I think gold is going to probably chop sideways for a bit, and then if it could base long enough and not move into a bear market, it'll keep climbing. I don't think that the big banks are done accumulating gold. I think that's like a long multi-year trend, and we'll continue to see that happen. So I think gold's still a play. And then I think the AI play is still big. We have a bunch of small caps that we trade in the fund when it's risk on to do so, and we get those signals from dark pools and institutional data, and so when those they fire well. And right now I don't think we don't have any dark pool positions on. That's my like not financial advice take on what's happening. But again, like we don't, final thought is like we don't touch. We just try to bring more uncorrelation, let the markets do what they're going to do.
It's a little bit of smack talk going on in the group chat. I mean, in the chat room. Yeah. Moody, go ahead. I'll let you peruse that while I give my take. It doesn't take a genius to see that there's some pretty significant sector rotation going on right now. I personally do not think the degree of rotation that we're seeing is bullish in what I would consider to be the intermediate term, which is in the next year to 18 months. I think that, if there are places to get bullish, right? Some of those places are overseas. There's some really interesting markets to get bullish on overseas right now. And ultimately, to me, that's the strongest argument for emerging markets. But what complicates that discussion is ultimately policy here that affects the dollar. So that's complicated. But as far as like when people are really asking if I'm bullish, they're asking, can I buy all NVIDIA calls? And I think the answer to that is no, but also consult your financial advisor and do whatever you want. I don't see a lot of straightforward higher for tech in particular. That doesn't mean I think tech is going to like puke its guts out and dip 40%. But I think the assumption that this year will be volatile is correct, but I think it's going to mostly be sideways for a year to 18 months as we go through this rotation. Rotation is bullish, but it's bullish on an appropriate time frame. This is healthy. This market needs to go sideways or lower. And you basically, like in my opinion, you have two ways to do this whenever a market gets overextended, which it's arguable whether we're actually there right now or not. But you either have a really violent correction like we had last April, in which case you buy that dip, or you do it really slowly and painfully like we did in 2022 and like we've done lots of other times, which is a quote unquote secular bear market. So, it would be great if we just puked 30% and then we could just buy it and forget about it for a couple of years, but I don't think we're going to be that lucky this time. Yeah, I don't see a driver at this point. So I think it's going to be kind of painful chop lower for a while, in tech in particular, while this rotation completes.
I think directionally you guys are pretty on the same page there. I think it probably in individual sectors and individual plays probably a little bit further
apart. I know.
It feels like we talk every day or something.
Yeah, almost like you guys work together. So yeah, I mean, it sounds like what you guys both said, volatility is going to be kind of key going forward, and that's something that we've heard. At the Apex Innovation Summit last year, Mike Tracy at Apex dubbed 2026 year of volatility, and I think that's something that's kind of played out going forward. So we'll get to Q&A. If you guys have any questions, please post them in the chat. One thing that we received a lot of questions over the past week and a half. And I'll split, there's two questions here. One, how can I invest in Enders? And then two, is Enders hiring? So I'll let you guys take that.
Yeah, I mean, we're open to accredited and qualified clients. All you have to do is fill out a form on our website, enderscapital.com, and we'll go through the details. And if it's something that's a fit, then yeah, you can absolutely invest in Enders. I think are we hiring? Hiring is hard at this size. We just can't afford people in the traditional manner and like terms of salaries and things like that. Our group right now, like the people at, like nobody makes money at Enders. We kind of do it collectively because we're either investors in the fund or like we just figure out, I think amicable terms. And, I think everyone's looking to a future where eventually we are a $100 million fund and we are able to hire people and do all those things. Someone asked earlier if, what's it take to what's the cost of running a fund? It's about like $50,000 a year in terms of admin costs and legal fees and tax and accounting. Yeah, 50 to 75
at this scale, right? At this scale,
which we're not making any money if that's the question. But we'll see how performance goes and maybe we can make some money there.
Great. So looks like somebody asked, how does short-term trading eat into performance? When holding a low-cost index fund make more sense for most people?
Buy and hold.
So like a traditional buy and hold strategy. Sounds like that's what somebody's asking.
Does the short-term trading eat into performance?
He's talking about commissions, fees, switching positions all the time.
There's commissions there's such a tiny fraction of it's a couple of bips.
So yeah, no commissions on Composer. Maybe they're talking about TAF fees, trading activity fees related to...
Or potentially tax implications, which is worth understanding.
$27 per million. Tax implications as well.
Depends where, everyone's tax strategy is completely different. I have real estate, and so I have depreciation that helps me with that. I think depending on what state you live in, I live in California, probably the worst state to live in, but, if you live in... it's really I'm not a CPA. So I think the idea is that I think at the end of the day, the reason we're running these strategies isn't necessarily the upside. It's a lot of the times it's like what happens on the downside. And, if you are sitting in QQQ or, SPY, at some point there's going to be a 50% drawdown. Ideally, we don't have that, and I can't sit here and say we're not going to have some sort of drawdown. We probably will, but we'll probably recover a lot quicker, at least, according to what our models tell us. But the idea is you're paying for and you're using these models so that way you don't have linear risk. Right? You have actual strategic and active management, and you're able to not have that kind of risk when those things actually happen. And then hopefully the upside is also better.
I would agree on pretty much all counts.
Yeah.
The compound decay, I think, is something that's maybe a little bit underappreciated. There's a reason that there are hedge funds that annualize 5% a year but have 10 billion under management, and that's a safety thing. That's because they have drawdowns that are extremely, extremely small, and for a certain goal, all they're really trying to do is compound their money over time. Let's say that our returns don't outperform SPY, but we see a 30% correction, and we only are part of about 10% of that correction. We have a 10% drawdown, but then we resume our beta to the SPY. Well, that's 20% that you just saved yourself. That's a big deal. Now, obviously, if it was so damn simple, why wouldn't we just do that, right? But that's why this active management matters, and it depends on your goal and what the purpose of that money is. Buy and hold is pretty much always going to work. Just don't sell ever until you're in your 70s, and it's going to compound. You'll do okay. Just buy the SPY and forget about it. But if you're interested in something different, then that's the realm that you're stepping into here.
Yeah. And just to reiterate, we are not CPAs. This is not financial advice. You should seek a tax professional as well for any tax advice.
Sorry, we can take on IRAs as well as clients. So a couple of our investors are invested through their IRAs.
Perfect. So one last question, because this came up, I saw 3 or 4 times in the chat. How did tariffs affect your strategies? Because that was the last major thing that kind of hit a lot of different people. Was that something where you immediately remodeled? 0. All right. So speak to that a little bit more.
No,
you just ignored it completely. Your strategies handled it. How did you?
It was a dip to deal with, right? It was volatility to deal with. So from a fundamental standpoint, there's an asterisk to this comment, but there are not fundamental things about the market that we watch that we really care about that much, like PE ratios. We don't care too much about those things because ultimately what these algorithms are trying to do is to figure out where money is going and to join that money. Or if money is leaving, to get out of that position or capitalize from that capital leaving. Right? This is what we are doing with these algorithms is a capital flows game. All we care about is where money is going. We saw some really, really painful deleveraging in April of last year because everyone simultaneously shit a brick and had been over levered for the straight up and to the right price action for the last year and a half. But the decisions that we made ultimately, like there were some changes that we made during that time period. It was not because of the tariffs. It was because of the price action. And that's pretty much it.
Great. Moody, anything to add there?
It's funny, like we didn't have our gold algorithm actually running. I wonder if like we would have done even better if we were running our gold algorithm that we were running, because gold was up and to the right during that whole process, which is hilarious. And like that's just again like how our philosophy has kind of changed quite a bit, is like run the uncorrelation, like run the negative beta, run all that stuff, because I mean it could happen next week. This is maybe a break week because you had Vixpiration yesterday and you have OPEX this week. Maybe we're just breaking and everything's gonna hit the fan next week. We don't know, but like I think running the models that we have running is in preparation for that type of scenario. And again, like we're just trying to be prepared and minimize the risk from whatever the market brings us.
Fantastic. Looks like we got through most of the questions and we answered a lot during it. Moody, Riz, thank you guys so much for hopping on and sharing your performance review of your fund, and then also, kind of getting a sneak peek at your dashboards. And thank you everyone for tuning in. If you have any questions, please don't hesitate to reach out to Composer directly at help@composer.trade, and check out Enders Capital on all of its socials.
Yeah, and then feel free to connect with me on LinkedIn if you'd like.
Yep,
Moody,
same
Nashawaty,
here. Risley, just like you see it on the screen. Any questions you have? I know there's a lot of questions we didn't get to, so just shoot us messages.
Fantastic. Well, thanks everyone for tuning in. Moody and Riz, thanks. We'll talk soon.
Thank you.